Welcome to the Patrick Real Estate Show, where we explore the fascinating world of real estate investing with your host, Patrick Switek. Patrick is a dynamic young entrepreneur and an accomplished real estate investor who's passionate about helping others achieve financial freedom. Each week, we sit down with some of the most inspiring individuals in the real estate industry and delve into their personal journeys, lessons learned, and secrets to their success. Let's dive into this week's episode.
Jacobie, welcome to the Patrick Real Estate Show. For the listeners out there, Jacobie has a special place in my heart because he's doing something that is very complementary to what I've been working on recently, which is buying management companies. Jacobie is one of the most premier short-term rental focused property management company, business acquisition companies. So brokerage companies to be specific. So they broker deals for STR property management companies and help facilitate acquisitions on both sides. And so he has a wealth of knowledge when it comes to buying and selling property management companies. We're going to be talking about even how to best position a management company to sell. What are the things that buyers are looking for? Because he's working with all the big buyers, the Vonstay, the V-Trips, Vicasas of the world, and C2G advisors. It's the brokerage. You can look it up. But I'm happy to have him here and to really just share our authentic conversation together. But welcome to the show, man.
Thank you, Patrick. I'm excited and I appreciate that intro.
Yeah, absolutely. So let's start from the get-go. How did you even get into this space of brokering these deals?
Yeah, I'm probably one of the unique ones in that a long time ago, in the late 80s, I was actually born and raised in this crazy pirate industry. So I grew up in the 90s stripping beds, taking trashes out, probably breaking some child labor laws. But my father he's known as one of the pioneers of vacation rental 1.0 or short-term rental 1.0. So I grew up as a child being a part of that, not really knowing what it was. Went many different ways in life and then got sucked back in 2017 and really started to focus on professionalizing the industry in terms of consulting and then also in terms of as well. I think 2017 would be like when I came back into this industry full on for sure.
Wow. That's awesome, man. And so you started, when did C2G Advisors start?
Yeah, so it's actually, my father founded this company back in maybe 2004. And then I came on board in 2017. So it's been around for a long time. And its goal is to really help just professionalize the industry.
That's amazing. You focus on short-term property management companies, but do you do anything outside of that as well? That maybe deals that come about, maybe a car wash or something along those lines?
Yeah, good question. So we stick in this industry for sure. So we haven't done deals outside of the industry. However, as like this industry, the pie is like ever expanding. And so when I came on board in 2017, it was during the time of when the more urban lease arbitrage master lease companies were going through their blitz scaling. The Saunders, the Stay Alfreds, the Lyrics, you name them, they were raising $50, $100, $200 million, whatever it was. Wow. There wasn't really a facilitator of these deals around the country because this entire asset class was brand new. And so I quickly trained myself into what some of these deals look like, and then we started, that was one of the services we added. We were helping them negotiate full building master leases or floors and stuff of that nature. That used to be a service we did. Obviously, unfortunately, that ended pretty terribly for a lot of the companies, which we can discuss that another time. But yeah, so did some of that. We also do some software sales in the industry. We'll sell some of these technology providers as well, but primarily we're focused in this short-term vacation rental industry.
Nice. Yeah, so I do want to go back to the rental arbitrage because that was a big thing. And I know a lot of companies pivoted. I was working with Vonstay in 2019, and they were very bullish on the rental arbitrage, or as you call it, the lease model. What kind of happened in that industry? Can you still buy companies like that? Do you recommend buying companies like that?
Yeah, great question. So I think there's probably a lot of things that happened. From my vantage point, what I saw was greed. and greed killed the industry to an extent. What had happened was these venture capital companies had deployed $50, $100, $200 million in, so they need their companies to scale rapidly. And then landlords and developers started understanding that these players would pay above market price per square foot and sign longer term leases. And so they started doing RFPs and getting these companies to compete against each other. And we would see 10-year initial term leases that were structured like triple net leases with escalations every year. And that were 50 to 100% above market rate on a price per square foot. And like that model is just going to break. They saw that. We saw it in the office space with WeWork, Industrious, some of those did the kind of, it's same story, different game. However, there are some hustlers, some groups that kind of went a little bit under the radar, may not have raised 50 million, that have like actually built some pretty strong cash flowing businesses. And I think that's super cool. And I'm very impressed with them. I talk to them quite a bit. Unfortunately, there's not much of an appetite for M&A in that asset class or niche within the industry. So an exit path, I would say, is very challenging if you have a lease arbitrage company. If it's cash flowing like a beast, great, that's awesome, keep doing it. But exactly. It is going to be, it is tough for that. And maybe the world will come around and that will become sexy again, but today it's not.
Yeah, what's really interesting about that is I had Syed on my podcast, Syed BNB. Love the guy. He had a great story. He talked about the collapse of that and how that was an opportunity for him to scale. He has 350 now in Chicago. I believe it was Domingo. And Stay Alfred was one of the companies that just lost all these leases, and he picked them all up. And he just maximized that opportunity, and it was awesome. Which we could talk about how Vacasa's doing that right now with everybody else picking up on Vacasa. A whole nother conversation. But yeah, that was a really good opportunity where people saw that and came about it. Now let's transition. Vacasa. What do you think is happening with the industry with Vacasa buying these management companies and all of a sudden losing crazy market? Not in every market, of course. There's definitely some markets that dominate really well, but there are definitely some markets where people are literally, it feels like every boutique manager is picking off Vacasa properties. What have you been seeing from that perspective? And
yeah, so it's tough to see Vacasa right now for our industry as a whole. Like, that's a window into our industry from the investment community. And the only comps they have for our industry are from Sonder and from Vacasa. So when they're looking at stuff, like, that is tough. And so I do not want Vacasa to fail. I don't want Sonder to fail. They are having a lot of trouble in the public markets. I think that's quite apparent. What I think has been something that's been just very tough, and this happened not just to Vacasa, it was some of the other serial acquirers, is during the go days of, call it, second half of 2020 all the way through first half of 2022. So that 2-year period was just gangbusters for M&A. It was the most I've seen in my career. Wow. And groups were out, Vacasa was out, other VC-backed companies, private equity-backed companies, larger strategics, they were out buying everything. And all of these companies that they were buying, these buyers were paying a multiple of the last 12 months. That's the time period that these buyers value these companies on. And it was the best 12-month period that any of these companies have ever had. And now we know, looking back, that it was inflated by maybe 20, 25% for all the various reasons, that COVID reasons for travel. So those groups like a Vacasa were paying a solid multiple, even at times a premium multiple, on the best 12-month period ever. And then 12 to 18 months later, the whole market's come down 20, 25%. So even without having any churn, if you have zero churn, if you keep 100% of the homeowners that you buy, you're still going to be down 20, 25% in EBITDA from your acquisitions. Now layer in the fact that acquisitions are tough in this industry. Even the best have troubles with churn, and some of them do better than others. And if Vacasa was having 5, 10, 15, 20, whatever the case may be, like every deal is different, that just makes it exponentially hurts those deals. I think that happened with a lot of buyers during that 2-year period. Everyone thought the music was going to keep going on forever. And it's been tough for some of those groups for sure.
Wow. So in that retrospect, so you mentioned that you don't want companies like Vacasa and Sonder to fail. And in this instant, obviously there was, even with let's say, assuming no churn, there's still a dip in the market. Now, why don't you want Vacasa to fail? Is it because it's a model for the whole short-term rental industry, and it's what gets people to be like an appetite for this industry? Is that what?
Yeah, I think internally in the industry, we look at, I know we're saying Vacasa, but we look at Vacasa differently than people from the outside, than Wall Street, than investors.
Right.
Investors have one lens into this industry, and it's from the public comp. And we want that public, as a whole, as an industry, we want that public comp to look as great as possible, because that's only going to further the investment into this industry. And that's going to push more entrepreneurs, more homeowners, more guests, more investment. That's just going to help push this industry forward and keep growing outside of this kind of mom and pop, or even get rid of some of these bad actors. So I think for that reason, I think that definitely would help. Yeah, that's where I'm going there.
Yeah, that makes total sense. And we're in the know because we're in the industry, but not a lot of people understand that, so that they go off of whatever Avance or Vacasa or like one of those big companies. Like that's what we could model after. But there's always a chance that somebody else takes the reins, so you never know. But yeah, totally get it that way. Now, going back to brokering deals, you said you do about 12 deals a year-ish on average. Walk me through, how are those deals facilitated? What kind of things are these big, I'm assuming these are usually bigger deals, 40 plus kind of deals. What are the things that these big management companies are when they're looking to acquire somebody?
Yeah. So on average, our deal size is in the like 5 to 10 million range. We'll do a couple above that. We actually added a service starting this year going downstream. So we hired an advisor to really focus on the smaller deals, those call like 500 grand and below, because I feel like there's a huge need for help for buyers and sellers there.
Saying EBITDA, 500 or less EBITDA, right?
Of total purchase price.
Total purchase price. Got it. Okay.
Yep.
Cool.
But yeah, generally how it goes is we'll get a hold of a seller, however that may happen, through eBlast, through they approach us, fill out our form, hear us talk about whatever the case may be. And with all of that, like, we want to make sure we're aligned with the potential seller before even moving any more forward. So we'll do an evaluation of their company. That takes about a week or two. And with that, we'll give them a tight range of what they're currently worth. We'll do a light SWOT analysis on the company. So if I find something about them that I'm like, hey, you're not sellable for this reason, like go spend the next 6 or 12 months fixing that. We do a homeowner agreement assessment. And then we also do a KPI scorecard of their company, because we've been gathering so much data over the last couple of years. We do about one valuation a week, and then we sell, call it 12 or 15 companies. So we're getting some pretty strong data now. So we now go to companies and say, hey, your payroll margins are this. Here's what your peers' payroll margins are. Or, hey, your take rate is this. Here's what your peers' take rate is. So we've been able to create a pretty cool KPI scorecard. I'm excited about. As that grows, it's only going to get better. The data will. But yeah, we'll provide that to the seller. We'll walk them through the valuation. And if we're aligned on price and expectations, we'll go over how structures look. We'll go over the timing of how a sale looks. It's typically 4 to 6 months from start to finish.
Wow.
So you have to you can almost backtrack, be like, hey, do you want to sell right before peak season? Okay, let's start the process on this date, so you'll sell on that date, or whatever the case may be. Yeah, so then we'll go over the buyer list with them, which is anywhere from 15 to 30 buyers. It really depends based on buyer's criteria. And then we'll start reaching out to each various buyer, and we'll send them an NDA and a teaser. And if they're ready to move forward, then we'll send them. We build a SIM for the sellers, this confidential information memorandum, And yeah, it's a pretty structured process. We'll reach out to all the buyers. We'll tell them all, hey, you have 3 weeks to submit. Offers are due on this date. And then hopefully multiple offers come in, and we'll discuss with the seller about how we want to respond to everyone. And yeah.
Nice. Let's
And
talk
then the
about
fun begins.
Yeah, then the real fun begins. Let's talk about valuations, because I know it, but I want to iterate on that. How do you value a management company?
Yeah, great question. And we're still in a Wild West pirate industry. So like our goal is trying to standardize some of this, but here's generally how it looks. So companies that actually have EBITDA, that are EBITDA positive, and EBITDA is just an acronym, earnings before interest, taxes, depreciation, and amortization. You start at the net income at the bottom of your P&L statement, and then you start making adjustments. Companies that are 250,000, let's back up, sorry. Last 12 months is the time period, like I mentioned. Yeah. So that would be, for this, it might be May of 23 through April of 24. Companies that have a last 12 months adjusted EBITDA of 250,000 to $1 million is going to be between a 3 and 5 multiple. So a simple way to think about that is if a company's doing $500,000 in last 12 months EBITDA, they might get a 4 multiple, so they're worth $2 million. Once companies get over $1 million of EBITDA, really like 1 to 3 million, you can start seeing a little bit of some multiple expansion. So 5, 6, 6.5 multiple. Wow. And it goes from there. Like we've done deals in the high single digits. We've done deals in multiple digit multiples, 10 plus. It really gets, it just goes a level up, and the kind of the requirement of professionalism goes up as well as you're growing that business. That's one end of the spectrum. Okay. The other end is typically these either EBITDA negative, or call it like less than 50 properties, but really like less than 25 properties going downstream. And there are outliers, but hopefully no one kills me for saying this, but most of these companies are more of a collection of contracts than they are actually companies at this stage. It's like it's an owner, or it's a husband and wife that are running around like a chicken with their head cut off. There might not be many systems and processes. There may or may not be an employee, and you're just a hustler. You're hustling, which is cool. But the value of your company are going to be these legal contracts, these homeowner contracts. And typically we see around a 1 to 2 multiple of annual commissions for each contract is how those are valued. So if a property brings in $50K a year in gross rents and the commission rate is 20%, then that contract's going to be worth between $10,000 and $20,000.
I got to update that because you said 1 to 1.5 last time we chatted. Yeah, I guess it's just like it's a range. It depends on a lot of factors. So what makes those contracts, let's say 1 versus 2x for per agreement?
Yeah. So the first thing, if I'm a buyer, is it's the old adage, you name the price, we'll name the terms. Like that rings so true in this business. Like it's a mix of an art and a science. So like science-wise, I can tell you all day, hey, it's worth X. But every seller has a number in their mind, and that number could just be arbitrary. It just might be some random number that they stuck their finger up and they're like, this sounds great, I want $1 million. And you're like, your company's only worth 600,000. So that's where sometimes it can be, there's a number, whatever the number may be. So you as the buyer, that's one of the first questions I would try to ask a seller. Try to get to what does the seller want? Because they're going to try to play all like coy, and then you submit an offer, and then they might come back at 100% higher than what your offer is. Oh, I wish I would have known that before. But try to get what they want, what they actually want out of the deal. And if it's within striking distance of where you think the company's actually valued, then you can structure the deal to where you're protecting your downside. You're paying it out over time. Maybe it's more of an earn out. If the company does better, they get to that number. So that's where the 1 to 2 could look, if how that could look in terms of the structure. If they want a 2 plus all cash at closing, sorry, that's just not going to work.
Yeah. It's funny, Jacobie, I just analyzed a deal and they were $100,000 net. Obviously, like when you add in their salaries, there's maybe 200, maybe 250. And they were asking for $2 million. So It was quite a lot, and I get it. So I totally see that people just have these inflated because they were operating in COVID times where they've gotten offers that was in that range. So yeah, that's very
Yeah, some of
interesting.
those groups were paying, some of those groups like VC-backed companies were paying 1 to 1.5 multiples of revenue back during COVID. And some of these companies that had really bad margins, that 1 multiple of revenue looked like was actually a 10 multiple of EBITDA. So then the sellers would go around and tell everyone that like, C2G got me a 10 multiple of EBITDA or whatever. And I'm like, stop it. Like, it was, the buyer did not value you that way. Like, don't go promise everyone a 10 multiple of EBITDA.
That's
Um,
funny.
yeah,
Yeah, you
it's
don't want that kind
crazy.
of reputation. Then you're like, oh, wow, their expectations are going to go up from there.
Yeah.
So going back to valuing the contracts, and you said it was like term and price. Let's talk about the contracts. I get this question a lot. With the contracts, how do you assign those contracts or agreements? Like, how do you buy the company that you still buy the company, and then those with the contracts in the company are still intact, or how do you structure a deal for something that's a little smaller?
Yeah, great question. I'm not an attorney and I'm not a CPA, so disclaimers.
Mhm.
What I would highly advise any buyer is to buy companies probably under $5 million as asset purchases. And generally, the going up market, the larger deals are actually stock purchases. For these really small, couple 100,000, 12 contracts, 15 contracts, like for sure asset deals, like you don't want the liabilities of everything about that company from the day it was started. And that's the cleanest break for a seller and for a buyer. And so as the buyer, you either create a new company, so a new co, whether it's an LLC or whatever, or you assign them to your current one. I would probably advise to create a new one for that particular market or whatever the case may be if you're trying to go into an adjacent market. But yeah, that's why these contracts are so important. There is a clause that either needs to be in the contract or it can be silent. So there needs to be a clause that either says this contract may be assigned without the written consent of the other party, or if it says nothing, if it's completely silent. Both of those are generally viewed as assignable. Now, if it says this contract may not be assigned without the written consent of the other party, then that's when you actually have to get consent from every single homeowner before, which is still fine as well. That there's different ways to structure it. There's a conversion structure and there's an assignment structure, and both ways are fine. It's just when you're hitting the friction point with the homeowners.
Walk us through what conversion structures, in the sense that like you reassign them, right? Like you talk to the owners and, hey, go under my management company, and if they do go under your management company, then you get the dollar amount or whatever.
For sure. So conversion is honestly like probably the best because homeowners know from day one like what's going on.
Yeah.
There's nothing a little bit sneaky about it. Mm-hmm. So you're literally the seller is selling the relationships to the homeowners, and the homeowners are signing, they're converting their old contracts to new Patrick contracts. And it can be, you'll want to have a lot of the similar language. Like you don't want to have completely different language because especially if it's negative language, they won't want to convert. But for those, like that's a huge pro if you're the buyer because everything's on the up and up. And so for those, like you may structure that to pay a lot more cash at close for properties that are converted. And it may not even have much of a structure after that, maybe a second payout at the end of the first year. But like when they're assigned, then definitely you have to have them structured based on timing of being still on the program.
Got it. So here's an interesting thing. As I was speaking more about this industry, somebody brought up, and it actually got me in a landlock where I was like, that is very interesting. And I didn't even think about this. So Jacobie, can I technically go and let's say I have my own property and I manage my own property and I have a contract agreement, separate agreement with my entity as a manager for my own property. Can I get paid for somebody to manage my property?
Yeah. We do that all the time.
Really? Is that a normal thing? So let's say that my property makes $100,000 and I put it under my management company. And instead of going out there and trying to take my property and just sign on with a service, I just sell it to somebody for the.
Oh, you're talking about just one property?
Yeah.
So typically when we sell companies, let's say a 100-unit company,
Mhm.
they generally own 2 or 3 of the
them.
properties.
Yeah. Yeah.
Yeah, the owners do separately from the company, but the company manages those properties. Sometimes it's arm's length, sometimes it's the same management agreement, sometimes it's discounted, sometimes it's zero. It all depends. But the buyer will value those properties like they're owned by any other person, as long as the seller is going to sign the same contract with the buyer post close. So yeah, it's treated very normal. Now, if the seller owns 25% of the inventory, then there's a much kind of more thoughtful conversation about typically a much longer term contract because there's so much more exposure.
Yeah.
Now the seller we can negotiate some terms in there saying like performance terms, basically like, hey, these are basically like covenants that banks have. If you underperform on my properties by X% post close, then we have the right to opt out, and there's negotiation back and forth.
Yeah. So what are some of those terms you can do? Because I did a little bit of consulting. I'm not going to talk too much about the deal, but the owner that was selling the company, a majority of the properties that were in the company were his own. And so with that in state, is there a way to guarantee, let's say they still want the liquidity of those assets in case they want to take it out from under the management? Is there a way to structure that deal, in your opinion, to make it so that if they're underperforming or if there's certain expenses that they decide to just make more money on certain things, like they can't just do that on their own properties, that kind of thing? You know what I'm saying?
Yeah. You can, for something like that, because it's such a big asset for the seller post close, then yeah, we'll want to negotiate the management agreement similar to negotiating an entire purchase and sale agreement, because that contract's going to be paramount for both parties after close. So we'll want to put in like some restrictions they can't do. You can't artificially increase our management fee by 5%. You can't do this. You can't do that. Just whatever's important. But typically performance is the number one thing. If during any 12-month period post close, the home does 10% or less revenue than the 12-month period that we delivered the home to you, then we have the option to terminate this agreement for this particular home. So it's a pretty like fair thing type of agreement there.
Perfect. That makes sense. Cool. With those contracts, do you see a lot of people buying, let's say, a management company that has a lot of contracts in different areas, but they have maybe 2 or 3 in a specific area, but you want to have those 2 or 3 because they're not prominent in that area? Can you just get those 2 or 3 contracts?
Say that again.
Let's say my management company. I'm in Joshua, but I have 3 properties in Palm Springs. It's not my main market. And I'm like, you know what? I want to sell those off to somebody else. Can I sell those off? Just those 3?
Yes. Yeah.
That's common.
You can sell those off. They're not going to be valued anything crazy, but it'll be similar to the probably 1 to 2, 1 to 1.5 times commissions for those. And what I would say for those, find a couple of the larger players in that market and shoot them an email and say, hey, here's the properties, here's what they made, make me an offer.
What if the owner doesn't want to switch over? So you would just do the conversion, right? You just wouldn't get paid for the ones that the owner. So that's the risk, right?
That's the risk. That's the tough part. Like these are all just contracts and owners. Yeah, it's up to them. But in terms of if it was, let's say you were trying to sell your whole kit and caboodle, you have 100 units in Joshua Tree and you only have 3 in Palm Springs. Palm Springs isn't that far. How far is that from Joshua Tree?
It's 45, 50 minutes. Yeah.
Okay. Let's say it's like Park City. You have 3 properties.
For sure.
And like with that, generally the buyers want a minimum of 25 properties in a market to really treat that market as like a strong market to buy as well, if they're trying to buy your company as a whole. So those 3 in Park City, like the buyer's probably not going to put minimal to no value on if they're trying to buy your company. So you may have to sell those 3 separately to a Park City, Utah company, if that makes sense.
Yeah.
So as one of the things I see all the time from these new entrepreneurs, and it's awesome, but I think it hurts them in the long run, is they grow wide, but they don't grow deep. And so we'll see these groups that are in 18 markets with 80 units total across 18 markets. I'm like, hey guys, that's awesome. get to 25 units in every one of those markets, get to 50 units in every one of those markets. Like, you're not enjoying the efficiencies of going deep. And buyers also at the end, they're not going to love just properties all over the place. They want to have some scale in these markets. Anytime I see those, I think that's great that you have a great ability to scale, but try to focus that in a couple markets than being everything for everyone.
Yeah. And I think you get economies of scale from there too. So
Yeah.
I want to let's transition into the fun stuff, right? The bigger deals. So bigger deals, we're assuming, as you said, what was a bigger deal versus a medium deal? What was the revenue?
I would say like anything over 10 million for a purchase price is a pretty good sized deal in this industry.
So let's think maybe a little smaller than that. I'm thinking for myself here.
Yeah.
I'm not quite there, but let's say a little smaller than that. 10 million, you said, in revenue per year, right? Or valuation wise?
I'm saying 10 million valuations. That's the total value of that company.
Okay. Let's talk about the valuation of that, right? How do you come to a valuation, right? Let's say that you have 50 to 150 units or something along those lines, or maybe more. Let's value that, because you said sometimes you can get valuation of 3x, and then other times you can get a valuation of 9x and 10x. Now, the big question is, especially for the people that are building companies, what differentiates somebody that has a 3x multiple versus somebody that has a 10x multiple? Like, I want to be sold for 10x. Imagine building your company and you're thinking, wow, I'm going to go for the big bucks. I'm going to get sold for crazy amounts of money. And you get a 2x multiple on your sale. And you're like, what the hell? What is going on here? I spent my whole life building this thing. And now, like, I'm making $500,000 a year and I can only sell for $1 million. What? Like, I thought I was going to be able to sell for $5 million. So I'm curious, walk us through what really do people look for when they're buying a management company like these big guys?
Yeah. To anyone listening to you, Patrick, if you have $500,000 of profits, please don't sell for $1 million. You're getting fleeced by the buyer. I can promise you that. So starting off just macro wise, market's important. Just where you operate at. Now, you don't really have control in that, or you may or may not have control in that. So the first thing to focus on and really to think about is market. Just where you operate at, that just for whatever reason, that's super important. So just being honest, if you're in a pure urban market, like, that's generally, there's less buyers out there. That's just basic economics. So there's more buyers want to be in these beach, ski, mountain, desert, more traditional vacation markets. So one, where you operate in is super important. If you're killing it, but you're in downtown Chicago, like, there's just going to be less interested parties there than if you're killing it in Joshua Tree or Palm Desert. So that's one. Regulations is the next thing. Unfortunately, or not unfortunately, just it is what it is. Like, we're all living through it. It's very fluid and dynamic. Things are changing. So there's two sides of this coin. I would say the majority of buyers prefer lightly regulated markets, but there's still a good amount of buyers that do like the regulation component, so they can build a moat around the company they're either acquiring or whatever the case may be. So that's another thing. Like it's for real though. Like, we took a company to market that was doing $1.5 million of profit in San Diego in fall of 2022. About a week into talking to buyers, a new proposed ordinance got put on the docket that would potentially make every property in San Diego was going to go through this lottery system.
Yeah.
And so everything got fluid. So every buyer said, hey, thanks, but we don't want to do anything until we understand what's going to happen. So we literally had to take them off the market. The sellers worked their whole life to build a beautiful business, and now they might get regulated out of business. I felt so bad for the seller. However, it went well. December of 22, I think, is when the lottery system started. During that couple month period, he just started doing biz dev like crazy, adding more properties just in case. So go into spring of 23, the regulations were set. He actually had a bigger company than he did when we had started, and we put him back out the market. He got 6 or 7 offers, closed with a great company, and everything was good. However,
multiples there, or no? Is that confidential?
Yeah, he got those types of deals are like 5+ multiple is how that looks for companies over $1 million of profit. So those are two things that you can control and can't control, more or less can't control. The controllables of kind of what makes you go from 3 to 5 is, so it's a couple of things. So one is the team. As you're growing, as you're at 100 properties, what does the staff look like? Have you started hiring in either an ops manager or director of operations or GM or whatever you want to call that position? How does that look? How does the homeowner relations role look? Who is talking to those homeowners on a daily, weekly, monthly basis? Is it Patrick? If Patrick's doing all of that, then that's going to make it a little bit tougher for a buyer to want to pay a high multiple. And they also might structure it to where you have to stay around longer than you would have wanted to post-close. So that's the team thing. In terms of just everything is growth-oriented, and where that starts with is property count. So buyers, one of the first spreadsheets they ask if they're looking for a well-run 100-unit company is, what is your units gain, units loss report? And so they want you to be keeping track in Excel or some spreadsheet of how many units you're adding every month, how many units you're losing every month, and reasons for that. So you can quickly, for one, even if you're not trying to sell, it's best practices, and it's really going to help if there's a leaky bucket. You can really find out what's going on quickly if you're losing properties, and it just helps with that. If you're not keeping track of that, like start tomorrow, you can quickly just do the on the columns, have the months, and then go from there. That's super important. So they're going to want to understand what your churn rate is from that. And that's going to be, your churn rate is basically the units at the start of the year and then how many units you lost throughout the year. If you have 100 units, you lose 8 properties throughout the year, you have an 8% churn rate. The average company in this industry has around an 8 to 10% churn rate per year, with most of that being from sales of the homes. So you literally, just to stay flat, you have to add 8 to 10 homes a year if you're at 100 units just to be flat. So if you're growing and that's your net growth rate, if your net growth rate is 10, 15, 25%, like awesome. That's showing these buyers, they want to buy great companies that are growing. As opposed to like downstream when you're trying to do some of these contract purchases, where you're maybe trying to find some deals. When you're growing, these buyers are okay paying up for companies that are growing. So ones that are growing, ones that are keeping track of their churn rates, and then growing their EBITDA margins as well is super important. What we typically see in terms of like payroll margins, because payroll is the largest expense for any of these companies, generally is around 20% of your revenue. So if you're either way above that or way below that, like buyers typically will want to try to understand that more. So that's obviously important just to know that. And then the last part that's super important is
not payroll. Are you including owners' payroll or no?
No. So payroll is going to be your W-2 employees, and it's not going to include contractors either. It's not going to include cleaners. Okay. And when I say revenue, I'm talking about commissions plus all your fees. So after you paid the homeowners their disbursements.
Yep. That's important.
Okay.
Because people also are like, my company is a 8-figure business. Maybe in booked revenue, but not management revenue. So that's a huge difference.
I talk to 10 companies and I say the word revenue and I get 10 different answers on what they think revenue is. So
how do you clarify that?
Yeah. So I've got a couple terms. So you've got GBV, which is gross booking value, and that is going to be the top, everything thrown into the bucket. Okay. So that's going to be your gross rents. So gross rents is the nightly rate that the guest is paying. So that's going to be your gross rents plus all of your ancillary fees, the housekeeping fees, the booking fees, the cleaning, the limited damage waiver. So gross rents is the total, the nightly rate the guest pays. That plus all the ancillary fees equals the gross booking value, okay?
Yeah.
So then the revenue to the company is going to be the commissions from those gross rents plus all the ancillary fees. So that's generally how the best-in-class companies are recording that on their profit and loss statements. And so if you are recording on your P&L, if you're actually recording the gross rents on your P&L, then having a line item for owner disbursements, like that's generally not best practices. So typically the P&L revenue should just be commissions plus all ancillary fees.
Got it. Okay, cool. That makes
I know we're going down random rabbit holes.
We're in a rabbit hole. Yeah, I was going to say. Cool. So, yeah, let's go back to what makes a company 4X versus 7X. Yeah.
So the last one, really like the most important thing here is, as I talked about growth, the PMSs in this industry are getting better. So this is dependent on what PMS you're on, if they actually have the capabilities. But there's also great data aggregators like a key data dashboard that there's this report that's super important. It's your advanced bookings as of today versus as of today last year. And it's the quickest snapshot to see how am I looking in future bookings versus this exact day last year. And that's the second report the buyers will ask for immediately. And Key Data has amazing charts right there. They suck it from your PMS. Some PMSs don't have the capabilities to look at what last year's advanced bookings look like as of today. So you're stuck there if they don't. And please talk to them to try to upgrade their services so they can do that for you. But so that's really a way to see, hey, am I flat versus this time last year looking forward? Am I behind 5% or am I ahead 20? If you're ahead 25% going into peak season, and then same time last year, like you're going to have so much more leverage than if you're down 10%. And every buyer is going to ask that for one of their first things. Give me your advanced booking report for same time last year. And so that's huge in that sense.
Even like smaller buyers, like not for management contracts, but like for bigger companies, I'm assuming.
For companies that are, call it like $500,000 of EBITDA and bigger, that's likely what they're going to be looking for.
I'm like taking notes as we're talking. Like, I didn't know that one. So this is good stuff, man. This is good stuff. Because I'm thinking, I'll be honest, I'm thinking about long term, there's going to be an exit with this. And we can talk a little bit offline about that, of course. But yeah, that's cool. Anyways, continue about valuations. What about contracts?
Yeah.
Aren't they important? If you have month to month versus if you have year to year, what is the friction point of owners leaving or not leaving, that kind of stuff, which I guess comes to churn rates and all of that. It plays hand in hand there.
Yeah. 100%. I know we've spent probably 20 minutes talking legal on this podcast. So sorry to anyone listening. That can be boring at times. But yeah, the real assets of these companies are the contracts. And I know I brought that up before. So like the strength of these contracts are pretty vitally important for these deals. We went through the assignability clause that could or may not break a deal, to be honest. But yeah, understanding like that, making sure that there's auto renewal on the terms. Some of this stuff is like 101, but some of the stuff is you wouldn't believe. Some of these bigger companies that still have some of these month to month, or you have to literally go in front of the homeowner at the end of every term and have them re-sign a new contract. I'm like, get rid of that friction. Wow. No, we want no friction with these homeowners. So auto renewal, at least annual terms. If there's going to be like 90-day outs or something of that nature, make sure there's some owner hooks in there, making sure that, hey, all bookings are already on the books, like we're due our commissions for those, and a couple other components like that are important. But yeah, buyers will they'll diligence the contracts as well for sure.
Nice. Let's talk about structuring the deal, because I think this is also something that people talk about a lot. What are some of the ramifications you can add to your deal to make it so that it's better structured for a buyer, right? Like you don't put is it all cash up front? Do they finance? SBA loans work? Walk me through that.
Yeah, sure. I'll start at smaller deals first. Some more of these like contract purchases. So you're like fastball down the middle, 15 unit contract purchase in the Smoky Mountains. Generally for that, you'll see between 40 and 60% cash at close is how that will look. And then the additional, let's call it 50% cash at close. And then maybe 2 tranches of 25% payments each year. So at the end of year 1, you'll actually, in the purchase agreement or in the LOI, like you'll want to do a table of all 15, do a quick table of all 15 contracts, assign a price per contract based on what their contribution was to the top line, to the revenue. So maybe they're all average 12,500 contract, but the one that brings in the most revenue is really like 18,000 and the least is 6,000 or whatever the case may be. 50% of that total value of the contract's paid at close. 25% is paid, let's say 6 months later if they're still on the program, or 12 months later if they're still on the program. And then the other 25% is paid maybe 24 months later if they're still on the program. And that's like a starting point. And then there's negotiation back and forth on, because it's a time component of how long you pay it. And then there's a monetary component. So amount down plus how long it can be. As a buyer, you probably want to stretch out as long as possible. As a seller, you may want it as short as possible. Also, like these smaller deals, these sellers typically have a pretty good brand reputation. The actual seller does even more than the company. So like putting a carrot in the offers about paying above market for them to help bring you properties during that payout period is a great way to keep the seller enthused and incentivize them to bring on new properties. So whatever, $1,000 a bedroom, whatever you can do, like to get them excited. That one, that'll help with churn, but two, that'll make them maybe bring on a couple more contracts.
That's awesome. I love that. And what about financing? How do people finance these kind of deals usually?
Yeah, it's a good question. So SBA lending banks are quite rigid about how they lend, and they really have to look at last 3-year financials. And unfortunately, as you go downstream with these deals, like a lot of these companies don't have clean financials, and two, like the last 3 years is like a roller coaster. So we are not the sweet spot for SBA. Our industry is not right now. Just to be fully honest, I've completed a couple of deals. We probably do one deal a year where it's financed from the SBA, but it's like pulling teeth. It can be pretty challenging for sure. Yeah. So really the best bet if you're a buyer is to try to get a large amount seller financed. That'll really help. But going back to you name the price, we'll name the terms type of thing. There's also ways to do it where you can, depending on the seller, like instead of putting much cash down, like you can do a commission split over a couple years where we say, hey, year one, we'll do a 50-50 split on commissions. Year two, it might go down to 70-30. Year three, 85-15. And just like walk them through on an Excel spreadsheet of how that actually looks cash-wise. And yeah, there's good things. You can say, hey, for future properties I bring on during that time, I'll do the same commission split with you. So that could be the carrot and stuff of that nature.
Yeah, I feel like we can talk about this so long. I feel like we've barely scratched the surface, but I'll let the listeners tell me the feedback. If they really like this episode, I'd be happy to bring you back on and we can chit-chat a little bit deeper on some of these kind of aspects. But I do want to get into the last portion of this, starting off with the first, which is what educational resources have you used in the past, whether it be podcast or YouTube channel or something like that's helped you get to where you're at in your industry, or just inspired?
Really going to some of the conferences is like a great way to, one, network, and two, learn some stuff. So that got me going. At that time, VRMA was the largest one, 2017, 2018. So that really helped a lot. I know now today there's a host of them. So that was something that helped pretty substantially there.
Awesome. And I have a special question for you. Where do you see the future of this industry heading?
Great question. I think that professionalism will continue all across the industry. There is a lot of private equity and institutional capital that has slowly been entering this industry over the last couple of years, and I think that's only going to continue. I think the kind of asset ownership, build to rent, propco, opco, I think there's something to be said there. I think they're going to create a pretty good niche within this big pie. I'm super bullish on that because you can finally actually control the interior of the units when you actually own the assets. So I think that's really cool. I think regulations are going to continue being a challenge across the country. And I don't know the best answer there. Like, I think a unified advocacy effort would be great. I just don't know if that can happen, to be honest, with every market just being so nuanced and having its own kind of norms there. But no, I'm really bullish on the future of this industry. I think it's going to keep growing. I think we're continuing to have new entrepreneurs creating new business models, And we just need the guests to keep coming and keep giving them a great experience.
That's awesome. And Jacobie, for people that maybe want to reach out to you and ask you, like, because you do take buyers, right? So people that maybe want to buy a management company, I'm a big advocate for, I've bought 3 management companies. I know there's so many ways. Buying a management company doesn't have to be so intimidating. It doesn't have to be a big one like you mentioned. It could be buying 10 contracts or something along those lines. Now, for people that want to maybe get onto your buyers pool for any kind of deals, or they want to sell their management company, how can they reach you?
Yeah, so our website, C2G Advisors, we have a contact us. Obviously, feel free to fill that out. You can email me at Jacobie, my first name, at C2G Advisors. I'm pretty active on LinkedIn if you want to DM me there. I'm not as much on TikTok, so I'm not a good influencer there. Also, we added a buy-side service about a month ago where we will help buyers with outreach and finding deals as well. So if anyone ever wants to talk about that, happy to. But yeah, that's the best way. Send me an email and let me know your thoughts, and we'll schedule a half-an-hour call.
Awesome. And I just want to iterate. It's C and then the number 2, G Advisors, just for people that are looking that up, not TO. And you were mentioning some new things in the works for helping people under 500,000. What's going on there? What's the future look like for you guys with that and everything that you guys are working on?
Yeah, it was born out of necessity. We have, to be honest, probably once a week, we'd have someone reach out to us. Hey, I want to buy 12 units in Scottsdale or 18 units in Outer Banks or whatever. And I always had to just tell them, like, hey, if we ever have a seller, we'll reach out to you. And I wasn't ever able to solve their issue. So I started thinking about how to help out this into the market. And I had a prior seller that actually sold their company in Nashville. He built a 75-unit company. I sold it a couple years ago. And he was a free agent. So we started talking and workshopping. And yeah, so we have the service. We have a couple clients now. It's great. We help on the outreach. So whatever market it is, we have what I think is one of the largest proprietary databases in this industry. And so we'll do outreach for these buyers, and then we'll help hold their hand throughout the entire process and help close the deal.
That's awesome, man. Well,
I'm excited. It's really fun.
You got to keep me posted on that one, because I think we can get some synergies going on that. Cool, man. Jacobie, thanks for sharing your knowledge, man. I think this was awesome. I could talk to you for hours. But yeah, I appreciate you hopping on, man, and just giving straight knowledge. Just appreciate you, man.
Patrick, thank you for having me on. This was a blast.
And that's a wrap. Thank you for listening to the Patrick Real Estate Show. If you found this episode helpful, please give us a follow and leave us a 5-star review. Your support truly means a lot. And connect with Patrick in the show notes below. Until next time.